Welcome back to Metal Market News. This is Professor Harry, and as always I'm speaking to you as an independent analyst where we don't just follow the narrative, we break it down, challenge it, and compare it with real macro dynamics so you can understand what is actually happening in the silver market. And right now what we are witnessing is a very unusual price behavior, because silver moving back above $70 in itself is not surprising in a bullish cycle, but the context in which it is happening is what makes this move extremely important and somewhat confusing for many participants, because traditionally when we see geopolitical escalation, especially involving the Middle East and rising oil prices, the expected reaction in markets is a stronger dollar, higher yields and pressure on non-yielding assets like silver. But what we are seeing instead is silver holding strength and even pushing higher despite oil moving above $100 and the dollar index also showing strength, which immediately tells me as an analyst that the market is no longer reacting in a purely textbook manner, and instead there are deeper forces at play that are overriding traditional correlations. And when we look at the intraday price action where silver dropped and then pushed back towards 71 and even approached 72 during the European session, it shows that buyers are still very active and willing to step in at higher levels, but at the same time the volatility indicates that conviction is not fully stable. And this is where I would slightly challenge the optimistic interpretation, because while the move above 70 looks strong on the surface, the internal structure of the market suggests that it is still in a tug of war between macro headwinds and structural bullish drivers. And this is typically what we see during transitional phases where the market is trying to decide its next major direction. And from my perspective, this kind of price action is less about confirmation of a breakout and more about a market testing the strength of buyers under conflicting conditions, which makes the next few sessions extremely critical in determining whether this is a sustainable move or just another temporary bounce. As we go deeper into the geopolitical context, the involvement of multiple players in the Middle East conflict, including the expansion through Iran-backed groups, introduces a significant layer of uncertainty, which in theory should increase inflation expectations through higher oil prices, and that in turn should push central banks toward a more hawkish stance, which historically has been negative for silver because higher rates increase the opportunity cost of holding non-yielding assets. However, what makes the current situation unique is that the market is not fully pricing in a sustained hawkish response, and instead seems to be focusing on the idea that central banks may look through short-term energy shocks, which brings us to a critical divergence between theory and reality, because while the textbook model suggests one outcome, the market is clearly anticipating another. And this is where many traders get caught off guard, because they rely too heavily on historical correlations without adjusting for changing policy behavior. And in my analysis, the reason silver is not reacting negatively to rising oil and geopolitical risk is because the market is increasingly forward-looking and is starting to believe that central banks will prioritize economic stability over aggressive inflation control, especially if inflation is seen as supply-driven rather than demand-driven. And this shift in expectations is subtle but extremely important, because it changes the entire framework through which we analyze metals. And while the script correctly points out the theoretical relationship between inflation and rate policy, I would argue that the market is currently operating under a different assumption, where temporary inflation spikes are not enough to trigger sustained tightening, and this is creating a supportive environment for silver even in conditions where it would traditionally struggle. Now when we bring in the monetary policy angle, and specifically the comments from the Federal Reserve Governor, this becomes the key catalyst that helps explain the so-called strange behavior in silver, because the suggestion that interest rates could be lower by around 1 percentage point over time, combined with the idea that short-term energy spikes should be ignored, sends a very clear signal to the market that policy may remain accommodative or at least not aggressively restrictive. And this is extremely bullish for metals, because it reduces the pressure from real yields and weakens the long-term outlook for the dollar, even if the dollar shows short-term strength. And this is where I align with the interpretation that these comments are playing a significant role in supporting silver prices, but at the same time I would caution against overestimating the immediate impact, because while forward guidance can shift sentiment, it does not always translate into immediate policy action, especially when the broader market expectations as reflected in rate probability tools still show a very high likelihood of no change in rates for most of the year. And this creates a disconnect between what policymakers are hinting at and what the market is actually pricing in. And in my view, this disconnect is one of the main reasons why we are seeing inconsistent behavior in silver, because different participants are reacting to different signals. Some are trading based on current data, while Others are positioning for future policy changes, and this divergence in expectations is what often leads to increased volatility and unpredictable price movements. If we shift our focus toward the structural fundamentals, the argument for silver remains strong, and this is one area where I largely agree with the bullish narrative because the sustained supply deficit over multiple years combined with declining above-ground inventories creates a solid foundation for higher prices over the long term, and when we add the growing importance of industrial demand, particularly from sectors like solar energy, electric vehicles and electronics, it becomes clear that silver is no longer just a monetary metal but also a critical industrial resource, which adds another layer of demand that is less sensitive to short-term price fluctuations. However, even within this bullish framework, it is important to maintain a balanced perspective because markets do not move in a straight line, and even the strongest fundamentals can be overshadowed by macro forces in the short term. And while the depletion of inventories and the scale of cumulative deficits suggest that the market is tightening, the actual price response can still be delayed or distorted by financial market dynamics, particularly the influence of futures trading and speculative positioning, and this is why we often see periods where prices do not fully reflect underlying fundamentals until a catalyst triggers a rapid repricing, and from my standpoint the current environment appears to be building towards such a scenario, but it has not fully reached that tipping point yet, which means that while the long-term outlook is positive, the short-term path is likely to remain volatile and uncertain. As we bring everything together and look at the broader picture, the performance of silver relative to other assets and its ability to hold above key levels like $70 despite multiple headwinds suggests that the underlying trend is still intact, but at the same time the unusual behavior we are witnessing is a reminder that markets are constantly evolving and that relying solely on past patterns can lead to incorrect conclusions. And in my final assessment, I would say that the bullish case for silver remains valid, but it is currently being expressed in a more complex and less predictable manner than many investors are used to, and this is where discipline becomes critical, because while the long-term drivers such as supply deficits, industrial demand and potential monetary easing support higher prices, the short-term environment is filled with conflicting signals that can create both opportunities and risks, and therefore as an independent analyst my view is that investors should remain cautiously optimistic, recognizing the strength of the underlying trend while also being prepared for continued volatility, because in markets like this the biggest mistake is not being wrong but being too confident in a single narrative without considering the full range of possibilities. And that is exactly why we break these situations down here on Metal Market News, so you can stay one step ahead of the market rather than reacting to it after the fact.